What's up, everyone? Welcome to Let's Talk Markets with Dave Lauer. I am your co-host, Pink, and today we have a very special episode planned. We've allotted an entire hour for this conversation today, as we are so excited to welcome a well-known and loved member of the online investment community, analyst at fintech firms, and author of the Dollar Endgame Peruvian Bull. Now, before we get into it, I just want to give a quick little disclaimer. Usually we avoid discussing specific tickers, specific investment strategies, or market phenomenon. But today we are having a focused conversation where we will be discussing specific tickers, and I'm sure you can guess which ones. So just wanted to give that quick little disclaimer for our viewers. Now, to Peruvian Bull, a recurring comment that I see under pretty much all of your DD is, dude, who are you? So why don't you tell us a little bit about yourself?
Sure. So, yeah, you kind of laid it out in the beginning. I'm a fintech analyst working in the startup world, but I had a really unique upbringing, and I've brought this up a few times. But I'm the youngest child of four by like 17 years, and so I was raised basically as an only child. My dad is as a PhD in atmospheric science. And he really like instilled this love of reading in me as a kid. And I also had because my parents are so old for my age. I'm almost 42 when I was born. We didn't have much technology. So as a kid, I was just reading and researching and learning. Like, if I had free time, I was reading books in the library, and that was basically like my life, because I had no computer and I had no way of doing anything else. And living in a neighborhood without many other kids, I just had to entertain myself somehow. And I was actually initially interested in biology and the more physical sciences. And that was my initial, going to be my path in life. I had an internship at a research, infectious disease research center. And I was dead set on that. And then I ran into the financial world in 2015 after watching The Big Short, and I started getting fascinated with what had happened during 2008 and trying to piece together the puzzle. And the further I started to dive down the rabbit hole, the more complexity and intrigue I started diving into, and realizing that the story was much bigger than anyone was letting on, was much more complex. And so I started doing economics research in college and on my own for 3 or 4 years. And I started getting connected to all these economics professors, to CEOs, to people, just because of my level of passion started to come through. And I just was so interested in talking to them about, what 2008 had actually meant, what had happened, and learning also just more about how the monetary system and the financial system worked. And apologies for everyone. I'm getting over a cold, so my voice is probably not.
Okay, you and the rest of the world, yeah.
Yeah, we really appreciate you joining us in spite of that. So no worries.
Of course. No, I'm mostly better now. So
glad to hear it.
But yeah, I was fascinated by how this, by what has happened during 2008. And then I started getting into, the global monetary system and how it worked, and what could go wrong, what had been happening, what was gold, what was gold's role, what was Triffin's dilemma. And the further I dove down, again, I found more complexity, and I just started getting really interested. And I was in some of my internships, I just by happenstance got connected with really interesting people who led me down further down this path. And I was basically doing all this on the side as a passion project, as just, I want to understand and learn and see how things work. And if there is going to be another crisis and it's going to be bigger, what is it going to look like? And then in 2021, I'm on super stonk, and I'm learning. Again, I didn't know about naked shorting. I didn't know about FTDs. I wasn't really a market mechanics person. I was more macro. And I was fascinated by this, but I started getting into arguments with people over, what is a global reserve currency? What is a global reserve asset? How could, some people said, oh, well, nobody needs dollars. We can just all sell, if the global system can just all get rid of dollars instantly. I'm like, well, no, that's not true. There's these inbuilt systemic demand for dollars. There's network effects. And all these people started arguing with me. And I was just like, okay, well, I'll write a post. I was like, I'll call it Dollar Endgame, and I'll just put it out there in New Rome, put the first post out. I remember I went and took a nap and sunbathed a little bit and woke up, and my phone was like dinging like every 2 seconds, notifications. And I looked, and it was basically going viral. And I was like, what is going on? And so then after that post, everyone's like, we need to hear part 2. Like, what's going to happen next? And so, or give us the next part. And I was like, okay, well, I'll give the next part. And then it just kind of snowballed into there. Into basically, I was able to upload this 6 years of economics research into a somewhat coherent thesis. And the thesis keeps changing. I keep learning new things, so I keep adapting it. But it's been a journey. It's been a ride, and now I'm finally been able to quit my job and try to do this full time and try to make a living at it doing macro writing, which is pretty incredible, because this is truly my passion and it's what I like to do. So I'm very grateful for that.
Yeah, that's great. Great story, man. And I got to say, as I initially came upon your stuff, it was I remember it being one of the things that actually changed my mind about Reddit and these online communities, because it was such well-founded research, and I mean, look, I love economic history. Not a lot of people can say that, all right? There are not a lot of us out there who are passionate about economic history, and who know what these things are and understand. History is just a great passion of mine. It's almost the only thing that I read in general. But where it intersects with my professional life is economic history, and I think it's so important to understand that so many of these things have happened before, and that we can learn from that, and that what we're about to experience or are experiencing is there's nothing new under the sun. The history, I like the saying, it doesn't repeat itself, but it rhymes. And I think in this situation, when I read what you had put together, and I've been having debates with people for many years that, I would be like, we're at the end of this debt-driven super cycle. And you need to understand that when you think about how things have been and versus what they're about to be. And you get the most blank stares possible when you start throwing those kinds of terms out at people. And I want to make sure we don't do that in this, as we talk about it. But these ideas are so important to understand. And for people who need to protect themselves financially and understand the system financially and the economic system, I think you've done some great work, and so I'm really excited to kind of dig into it. So definitely thanks for coming on here.
Of course, yeah. I think I wrote if I go back and read it, it's 200 pages. Was the rough draft, which is insane. I can't believe I wrote that much.
I know the first thing I have here is, for those who aren't familiar with your work, maybe you can give a quick overview, as quick as you can summarize a book's worth of material. But let's just start at the top. What do you mean by Dollar Endgame? And what different threads are sort of pulling together from a macroeconomic historical perspective to come up with this idea?
Sure. So I would say there's two main threads. One is the U.S. fiscal situation and debt spiral, and which is what I would call the monetary event horizon. And the other is the global reserve system, which is what I would call the sword of Damocles. And it's kind of a way to recontextualize and, reimagine what we've traditionally been taught about how economics works. Basically, the thesis is, and this is, again, it's not unique to the US, is every time a country becomes, a global reserve currency or a global reserve currency holder, they impugn on themselves or adopt upon themselves a massive responsibility and a massive, but at the same time, over time, they adopt this existential risk in many ways. And we saw this play out, if you read the Lords of Finance, which if you're a monetary economics nerd, you will love that book. It's very long. It's 500 pages. And so it's not for the faint of heart.
That's my kind of book.
Yeah. If you read this book, you'll see this exact process playing out with the UK and the British pound and their attempt to try to restabilize the global reserve system after World War I. And in that time, the UK had been inflating their currency, had been borrowing excessively to fund the war, and they tried to reset their pound back to the pre-war parity with gold. And what that meant is basically like they were overvaluing gold and undervaluing their or overvaluing their own currency and undervaluing gold, which meant that their currency needed to contract, and therefore they experienced a massive recession. And actually, they experienced technically a depression before the U.S. did, and that was part of the thing that helped to push the world off the pound standard and onto a dollar standard. And as World War II came around and Bretton Woods was formalized, and the U.S. became now the de facto world reserve currency holder, and gold reserves had flowed into the U.S., now the global system began to function on dollars. And so we began to need to export dollars to the global system on net in order to fund global trade deficits, to fund global liquidity, to allow the system to function. And this is what Robert Triffin brought in front of Congress in 1960, right? He said, this is a dilemma. This is a crisis. Like, this will be a crisis one day. We're running a gold reserve ratio of $35 an ounce, which means there's only so many dollars that we can produce. But the global system needs dollars. And as the growth of the world outside the U.S. increases, then their need for dollars increases because the total amount of trade increases. And if we don't want to allow them to run into a currency crisis, which means that they can't trade because there's just not enough liquidity in the system to do it, we need to export these dollars. But if we do that, we'll create new dollars, which means we'll lose our reserve ratio, which eventually means a run on the dollar itself. And he said this in 1960 in February, which is crazy because it's, that's 11 years before Nixon closed the gold window. So he was very prescient. But crucially, he called for deflation instead of inflation. And as we all know, we broke the gold standard. We ran into about a decade of high inflation, and Volcker had to raise interest rates to 20% to stop this. And the global system became a fiat-based monetary system. And instead of gold being the neutral reserve asset, U.S. Treasuries became the neutral reserve asset. And so as this process has played out over the last 40 years, the U.S. has run trade deficits and current account deficits, which means we're putting out more dollars to the global system on net than we're taking in. And all these dollars end up overseas. And so all these countries, we're talking about corporate treasuries, we're talking about foreign central banks, we're talking about foreign wealth funds, we're talking about sovereign wealthy individuals who trade with the U.S. or just trade in U.S. dollars. They have all these dollar surpluses. Well, what's the easiest thing to do with the dollar surplus is you just reinvest it back into the U.S. And so all these foreigners now own a ton of dollar assets. And I laid this out in that sort of Damocles piece, and this, again, this is actually, if for the people who are more well-versed in macro, it's actually well known. Luke Groman points this out, Lynn Alden points this out. The U.S. net international investment position is negative 63%, which means of GDP, which means on net, foreigners own more assets than we own of theirs. And so foreigners own about $42 trillion of our assets. And on net, if you balance out how much we own of theirs, it's about $29 trillion more of our assets than we own of theirs. And so that means there's all these overhang of dollar assets that exist globally. And if the U.S. loses reserve status, if the U.S. dollar loses its centerpiece, place that it exists in right now as the underpinning of the global monetary system, and these foreigners don't need dollars, what do they do with the assets, right? And that's kind of the thesis, is that we've enjoyed this exorbitant privilege. What French Finance Minister Gerard d'Estaing, I'm probably butchering that, said in 1960 to Kennedy. He said, "This is an exorbitant privilege. You're able to borrow and spend, and everyone else has to use your currency, and everyone else has to buy your currency, and you're able to just continually run trade deficits and fiscal deficits without, a major crisis occurring." And this exorbitant privilege eventually runs out for every reserve currency country. It never lasts forever because these imbalances get so great that it unwinds. And basically my thesis is that the unwind will be bad. If we lose reserve currency status quickly, and if other countries no longer need dollars and don't need to hold dollars against dollar debts and don't need to hold their assets, then they can sell these assets, and that can cause recession in the U.S., severe correction in the stock market. And then the end of the thesis is basically, right, the Fed restarting QE. And, kind of the point I was making is previously the Fed wasn't trapped. In other crises that we've had, the Fed has always had a solution. In the 1980s, when we're running into dual deficits and high inflation, the Fed is able to raise interest rates to 20% because federal debt to GDP is 30%. But today, that's no longer the case, and so all their options kind of make the situation worse in some way, just in different ways. And so that's kind of the basic rundown. Yeah, and all of this. What did you say?
I said, so you're bullish.
Yeah. Well, I'm
you're the bull.
I am the bull. Yeah.
He's not able. He's able.
It is a very bearish thesis, I won't lie. But the end goal, or the end of the thesis, is basically something like Bitcoin can be a new reserve asset, which can fix these problems that we keep running into of a reserve currency becoming a global superpower, abusing their power, invading other countries, becoming militant and domineering, and then falling apart and having to reset to a new status holder. It's not really a fair system, especially for poor third world countries that have to deal with it. So
I think that what you call the sword of Damocles, I've always sort of thought of as just mutually assured destruction, and it's actually one of the things that I think argues against your sort of outcome, which is the general. I think what you were saying earlier, that the things you're talking about are not. I don't think they're outside of the economic mainstream. Like these are things economists have been talking about for a long time, right? And and that's part of why I always found your analysis so compelling, was because it's so well grounded in things that most economists would not argue outside of, okay, but what does it lead to? What will this ultimately mean, right? And so you've had modern monetary theorists come along now and say none of this matters. We're the reserve currency. We can print anything. It simply doesn't matter, right? And so the question that I think is probably true as long as you're the reserve currency. And so then the question becomes, what is it that precipitates that loss of reserve currency status? And as long as you have this kind of mutually assured destruction, as long as most foreign reserves are held in US treasuries, everyone globally is incentivized to maintain the stability of this sort of economic hegemony, right? So what is it that you think changes that calculus?
Sure. And this is exactly like I wrote about this in that sort of Damocles, and I think it was Strange Things part 2 about the dollar milkshake. This is that exact pushback, is saying, look, not only, and of course what you mentioned is the Forex reserves and holding, dumping our assets will hurt everyone else. And so there's kind of this bomb that's tied to everyone, and anyone trying to undo the bomb will explode everyone at once.
And maybe actually real quick, maybe we should just take a quick step back for those that maybe aren't as familiar with this, but many countries out there hold US treasuries as the number one element of their foreign reserves. China being the poster child for this. I don't have maybe you have the number. Trillions of dollars of treasuries is in the Chinese central bank, and they use it to maintain their currency peg with the dollar. And every other country does the same thing, right? And that's how they need US dollars in order to conduct trade, because trade is dollar denominated for the most part.
Yeah, exactly. And so, all these countries, they're all tied together by this, this bomb, this wire that's a tripwire that kind of ties everyone to the system. And this is essentially what the dollar bulls called the Tina doctrine. There is no alternative.
Yes.
Their thesis is, look, and actually, the more I dove into it, I saw how powerful their arguments are. Like, Russia cannot be, despite all these gold bugs running on Twitter and saying, oh my God, like Russia, now their Russian central bank's buying gold, they're going to repeg to gold. The Russian rubles are going to triple in value. The dollar's going to collapse tomorrow. Russia can't be a reserve currency. They need to be net exporter of dollars. They're a net exporter of goods, which is the inverse. So they're a net importer of funds. So they can't do that. China has a closed capital account. It's very hard to move money out of China if you just ask any wealthy Chinese person. India doesn't have enough deep enough bond or stock market or enough rule of law or just general enough development. Like all the big countries that could be contenders just aren't. In the US, we have we not only have the network effect of the global reserve currency, we have the deepest and most liquid stock and bond markets in the world, which is necessary if you want investment to be done in our currency and trade to be done in our currency. And so this network effect has been extremely powerful and has allowed us to hold this reserve status, much longer and much longer, and will be much longer than most people think. And also I wrote the series and it has a bombastic title. But I kept saying this, and I wanted people to know, like, this isn't a 1-year process, isn't a 3-year process. I was writing about this in terms of like decade or longer playing out.
I've heard some of these ideas for decades. I mean, honestly, I remember something like 20 years ago talking to gold bugs about how the system, this was the end, and hyperinflation was around the corner, and you better own gold bullion. And I was like, oh shit! And like I bought a bunch of gold bullion. I was like, oh, I better have something that's worth something when all this happens. And here we are, like 20 years later, and you hear similar things from the Bitcoin community. We talked to Byron from Loopring, and he was talking about some very similar ideas as well. I will say that one of the things I really liked in your piece when you talked about, I think it was from the Singularity, and you talked about the sort of the interest expense and interest rate versus inflation, rock in a hard place that the Fed finds itself in. And it does seem like we're getting to the point where the US has gone into just an incredible level of debt. And that is taken place over decades, regardless of what political party is in power. We print money and we go more and more debt. It's like one of the only bipartisan things that the government seems to agree on is take on more debt. And now we're getting to this, especially after coming out of ZIRP and having zero interest rates, and there not being any real consequences to taking on that level of debt. Suddenly, interest rates go up, the cost to service that debt is increasing dramatically. And now, what are you going to do as the Fed? Do you continue to keep interest rates where they need to be to tamp down inflation, and in doing so, crowd out private investment because of interest expense, and that becomes like the single largest line item that the government has to spend money on? Or do you reduce interest rates to try to create economic growth and end up in an inflationary cycle?
Yeah, and actually, so before I touch on that, I wanted to finish the thread on the monetary system.
Sure.
I agree. Like this is what confounded me when I first started researching it. Is all these this story has been told before. U.S. losing reserve status, gold bullion going to 7,000, 10,000. Like I've seen all the charts. I was excited. I bought the gold bugs. I got the gold bugs thesis, hook, line, and sinker.
I bought Bitcoin really early too, because I bought that side of it when it first came out.
And did you hold it?
No, of course not. That would have been genius if I had.
Yeah.
Well, all right, let's take it aside. The best trade and the worst trade I ever made were the very same trade. I bought Bitcoin at $2.
Oh God.
And it went up to like $1,000, and I said, "This is crazy," and I sold all of it between like $800 and $1,000. And
my God,
the rest is history, because I'm too much
be in seed round if you just held on.
We would not have to raise any money for Urban if I just held on. That's for sure. But no, it was an amazing trade. I don't think I've had that high of a return on any trade. And yet, too much of a trade, not enough of a true believer at that time, I think.
I can't believe you already peaked, Dave.
It's all over. It's all downhill from here.
Yeah, that's right. There's nothing
Yeah,
else.
but yeah, like, I agree. Like, we've heard this before, we've seen it before. Anyone who's really deeply into monetary economics has seen these massive gold price move predictions, and you see this knee jerk move. Like, whenever gold last weekend spiked to 21.35, and Peter Schiff is out pounding the table saying, "This is the beginning of the new gold reserve currency. This is it," and then it just retraces back down. And the gold price is manipulated. I agree, but I think that gold has limited role in a modern digitized 21st century global economy. And so what the reason why I wrote this thesis, and the reason why I believe that the US can lose reserve currency status, is because of the emergence of Bitcoin. And again, we're still in the very early stages, but Bitcoin exhibits all the classic characteristics of a good, or even maybe even perfect, neutral reserve currency. It's, bearer asset, non-custodial, meaning you can hold it yourself. You don't need to trust someone else to hold it. It's there's no central person controls the supply or the issuance, just like how gold was in the 1800s. Trade, there is a limitation, of course, on the base layer of transaction speed, just because of the block size. 7 transactions per second, I think, is the upper limit. And this was actually what stopped me initially from buying Bitcoin in 2018, is I'd read a book by a software engineer laying out the problems with Bitcoin. And this was one of the things he pointed to, saying, like, look, Visa handles 40,000 transactions a second. Bitcoin can do 7. This isn't going to be a currency that everyone can use. And so I thought, wow, well, he's right. I won't buy any. And I kick myself every day for saying that, because this was, I was deep in this rabbit hole, and I didn't purchase any. And so, unfortunate, but that's the path I went down until I started researching and learning more in depth about the financial system, how layered money works, how there are different settlement layers: Fed wire, bank deposits, credit cards and debit cards, PayPal, all
gold,
these different settlement layers. That work.
It's hard to send a bar to someone, but you can send a coin, right, or some dust.
Exactly. And so, through this research, I started realizing that Bitcoin could serve the role of a neutral reserve currency. It's just a question of will institutions, will governments on a global scale start realizing that this is a better reserve asset. And right now we're sitting in a macro paradigm where, for the first time in 50 years, the US 30-year bond is down over 50%. And the 20-year bond is down like 28%. And so if you're holding long-term treasuries and you're another country, you're sitting on a massive loss. And now, again, you can hold the treasury to maturity, of course, collect the coupon, collect the par, and you'll be fine. But there is the question of what we touched on earlier, the unsustainable US fiscal situation, the debt situation. And I've always told people, look, the issuance schedule eventually is exponential. Is there exponential demand for treasuries? That's my question, because we can see it growing right now. This is the first year in history we've had $1 trillion of interest expense reported on October 30th of this year by Bloomberg. Through the first 6 months of the year, we had $608 billion of interest expense. At current rates, it'll be about 20% of federal tax receipts. And within a few years, it'll be at 40 or 50%. Right. And this dilemma that you just laid out, which is this, what I try to bring up is the Fed's dilemma with the singularity is, if they raise rates on the whole system to slow down inflation, but they do no more so than any institution than the Treasury, right? They do it the most so on the Treasury, because the Treasury has the most debt to reset. And so as the rates rise, Treasury gross interest expense rises, which means the Treasury goes deeper into the debt black hole, which means the subsequent, maturity rollover, they'll have to refinance more. We're running to the situation, and this is what I termed the Peruvian Bull debt paradox, where traditional Keynesian thinking, if you've read the general theory of money and employment, if you've just read normal economics textbooks in college, it will tell you that
from the guy,
it'll tell you that raising rates will slow down inflation, and that this will solve any problem that an overheating economy has. And I say yes, but the caveat is it's in a low total debt, or at least federal debt environment, because when you raise rates on the Treasury, you raise interest expense, you push the Treasury down the black hole, and if the Treasury is spending more and more on interest expense and the debt is rising and the deficits, the crucial part is if the deficits are rising as well, this means that the release valve from the financial economy to the real economy is growing. The amount of money that the federal government is spending is growing. And that can mean this is, I love to use the singularity, the event horizon, the black hole analogy, because, in physics, like my dad could lecture you for hours on physics and science, because he loves this stuff. A lot of traditional, physical theory or, gravitational theory breaks down as you approach an event horizon, right? Time slows down, light bends, particles can pull apart, right? If you enter a black hole, your body, the parts of your body closer to the black hole will start ripping away from you faster than your back. And so it's like you'll be ribboned out. Like all these weird things happen, really strange. And really no one knows what happens.
Right. No idea. But the event horizon itself, how amazing, right? It's in terms of like you can see everything in it.
Yeah.
All of history in the event horizon.
Exactly. You could stand at the event horizon and stare forward, and you'd see the back of your own head from minutes ago, right? Yeah. And so it's really trippy. It's kind of mind bending, and this is similar to what I try to term with with economics, the monetary black hole, is all these traditional theories of how things should work start to break down, and as government spending is an additive component of GDP. If you just look up, take an entry-level economics class, government spending is part of that. So we could run into a situation where nominal GDP is growing and inflation keeps rising.
Yeah.
And so our economy is by default growing because government spending is rising, but all it is the government spending more and more money and pushing more M2 deposits out and causing inflation. Yeah, and it could be, we could have 10% nominal GDP growth. That doesn't mean that it's real. And again, this can break all traditional models. We saw this. I mean, if you looked into the numbers of the most recent job report, was pretty good. But the reason why is because 227,000 jobs were added by government and healthcare. And apart from that, every other sector saw no increases. And so it's this weird situation where you can have great on the face numbers, great nominal, great unemployment numbers, and yet when you dig behind the scenes, it's not as great, and it actually is signs of problems underlying our system. And so
a lot of people were looking at the reports of the reverse repo facility and saying this looks like it is indicative of a serious problem. And we saw, that hit $1 trillion, and everyone's like, "Whoa, what the hell is going on?" And then it almost doubled, right? From there, and then it's been coming down since then. You said the Fed was eating the Treasury market. What do you think? Was the reverse repo facility telling us anything? And if so, what? And what do you think it means for this conversation?
Sure. The regards to the eating the Treasury market, that was a piece I wrote in 2021 with regards to QE, right? The Fed was increasing its total ownership of the Treasury market, which is approaching kind of similar to what the Bank of Japan has done, which is basically take over, buy every bond in existence,
right,
and make sure that monetize the debt completely. It's a process, right? But reverse repo was really, the more I dug into it, the more I understood it fully. And there's a couple of really good people who write about this. Michael Howell is one of them on liquidity wars. And basically it's a place to store excess liquidity for money market funds, for banks. And it also is a source of collateral because, the Fed is doing this funny thing where treasuries are, one of the backbones of collateral that underlie the entire system, right? Treasuries are an HQLA, which is high quality liquid asset needed on bank balance sheets. And as the Fed runs QE, it's buying treasuries. And if it's running a big enough QE program, it's buying not only a bunch of new treasuries, it's buying old treasuries and sucking treasuries out of the system. And so now all these banks have needs for treasuries as collateral, and there's not enough treasuries to go around. And so they opened up the reverse repo window to allow banks to park cash and then them to swap the treasuries back out and allow
so
these
that's
banks.
Why the number of participants went up too. It went into like triple digits there for a while, and because everybody's trying to get a piece of the pie.
Exactly. And that's why all these, at the end of the day, a lot of these companies need treasuries as collateral for Forex, for repo, for interbank lending. It's since 2008 that there's a really great writer on this, Concordanomics.
Yeah.
And since 2008, so before 2008, there was a lot of unsecured lending happening because it was just, no one was really worried about mass defaults. And after 2008, no
one
one
secured with some like junk tranche off a CDO, right?
Exactly. After 2008, not only there were new regulations putting in place more stringent collateral requirements, but just the market participants wanted collateralized lending. They did not want to have an unsecured loan out because it was just it scarred people psychologically. And so, there's this shortage there's a dual problem of an excess liquidity problem that was, all this cash on bank balances that they wanted to make interest on, and they needed treasuries. And so they fund that by going to the window, putting money there. And when money is in the reverse repo window, it's net negative to liquidity because now all this cash is trapped on the Fed's balance sheet. It's not out there flowing and moving between financial assets. And so one thing that's propped up markets, a lot of people have asked me, why have markets not, collapse? And it's like, well, because net liquidity, when you take into account all the things that can add and subtract from liquidity, net liquidity hasn't been falling. It bottomed in September 2022, and it's been slightly increasing after that. And one of the biggest things is reverse repo. Since May of this year, reverse repo has fallen by like 1.4 trillion. And so that means all this liquidity that was trapped in reverse repo, right? Now treasury issuance is coming back online. The Fed isn't running QE. There's more than enough treasuries to be collateral in the system. And all this excess liquidity is being able to funnel back into the markets and buoy up financial asset prices.
Yeah. So look, I think liquidity is, as you have highlighted now recently a bunch of times, it is like one of the most important things to focus on. It's the thing that has fueled this unprecedented market rally, thanks to zero interest rate policy. And so I wonder, do you struggle with this? Because on the one hand, like you talked this weekend, you said like you tweeted Chinese banks are in trouble, real estate losses are hitting hard. That's like that could easily kick off a global slump and a contraction. But at the same time, you also said global liquidity is about to rip upwards in 2024. And that chart that you showed was super interesting of, the cycles of liquidity basically. So, do you wrestle with this sort of short-term versus long-term view? Like that, you think this massive systemic implosion is on the horizon, but at the same time, if liquidity rips upwards next year, and I've seen a lot of bullishness in markets from analysts and from other people. I think a lot of people think we're about to have a soft landing. And we can get into your thoughts on that in a second too. But really, like just from a practical perspective, what do you think is about to happen, or do you think that's just a silly question because nobody knows, and it's just the long term that you need to focus on?
Well, so I'll preface this by saying I have a piece coming out on the Chinese banks soon, so I won't give out too many details. But that was regards to I'm doing some research on, some of these property losses, right? These developers and Evergrande, Country Garden is in technical default. Evergrande is declared bankruptcy and is currently in court proceedings to figure everything out. And several large banks have loaned to these developers and are losing money. But I actually see these things as not in contradiction. I see them as tied together. Okay. There's a crisis and then there's a liquidity wave. The liquidity wave is the response to any crisis. And like I said, we've seen this play out over and over and over again. And I've talked to people who are financial theorists, economic theorists who say, well, that's not in the Fed's mandate. Hey, PB, like why are you saying this? Like their dual mandate is inflation and unemployment. And liquidity isn't in their mandate. And it's like, yes, I agree. De jure.
Don't agree with that.
No. I say de jure. So by law, it's not in their mandate, but de facto, in reality, it is because you look at every single crisis
and maintain liquidity, right? Like, come on.
They respond with more liquidity, with more programs. I mean, with Silicon Valley's bank failure in just March of this year, they created the Bank Term Funding Program, and they inject $109 billion in liquidity.
To be fair, right? Like that program was a good idea, I think.
Oh, it was. Of course it was. If you want to pay, if you want to keep the system going, which is what they want to do. And
Right.
I'm not denying that what they want is the preservation of the system. I just think the way they do it is by increasing liquidity. And so I see these things as working together. The worse the fundamentals
how do you
get, the
square
more
that
liquidity.
with what you think is coming, right? So do you think at some point there simply isn't a bazooka big enough, right? Is because like the Fed and the government will do everything possible to prevent what you're talking about from happening, right?
You mean like in regards to what? In regards to losing
To the
reserve
dollar
currency status?
endgame and to Bitcoin becoming, or anything else becoming, the global reserve currency.
Yeah, they can. I mean, this is the amazing thing about Bitcoin is that they can try as much as they want, but it's virtually impossible to shut down a decentralized network like Bitcoin is run on proof of work. I mean, China banned hash rate in 2019. They banned mining, and the hash rate collapsed, and within 8 months it was back to where it is, and it's hitting all-time highs now. And
it's hard to I agree with you that it would be hard to shut down the decentralized network, but it is not hard to shut down on-ramps and off-ramps to it.
That's true. I won't deny that. They have a lot of tools in their arsenal. The question is, how far does this process go before they wake up to the threat? Because again, I think it's a real threat. I think we're still in the early stages, like I've said. I think this is a decade-long process, but I think it's an actual threat that they need. I'm not necessarily a huge fan of the current monetary system, but if they want to preserve it, that's what they would do. They would have to shut down the on and off ramps. They'd have to restrict exchanges, shut down all forms of crypto speculation, and make it a jailable offense.
Yeah, and for most people, that would be enough. And like for critical mass, that would be enough, right? Like there will always be people who are technically sophisticated enough to understand how to get around some of these things. And not saying that you can use a VPN to do that today, but sure, like that's probably one way of doing it. But at some point, they can make it hard enough for enough people that it has the effect that they're looking for, right?
That's true, but it also is a function of desire, of demand. Like the greater the base layer, or the worse the base layer conditions, the more the demand comes online for new currency, right? I have cousins in Venezuela, and we pay them in Bitcoin.
We have connections in Venezuela,
yes, and this is
the only
an
thing
extreme.
we can use, right?
Yeah, this is an extreme example, but dollars and Bitcoin are very hard to come by there. And all my cousins who live there have learned how to open up wallets, and my parents send them, and I send them a couple $100 a month, and that's enough for all their living expenses,
right?
Because they're able to sell the Bitcoin into dollars, and then use the dollars to transact and to feed themselves.
Okay, so let's go back to liquidity then for a second.
Yeah.
Okay, so in terms of your views on 2024, what do you think is coming?
I think. Well, look, we're running into this issue of exponential treasury issuance. I think the debt spiral is going to get worse. And I think the Fed is going to. I mean, I'm looking at market expectations. You look at the CME Market Watch tool. Most of the market's expecting the Fed cuts to begin in May, between March and May of 2024.
Right.
And if the Fed wants to keep things here, you got to remember, interest rate effects always lag by 12 to 18 months.
Yep.
And so whenever the Fed begins a hiking cycle or a cutting cycle, you won't see it in the data for a year and a half, and we only reached the peak a few months ago. And so the peak effects of this recent rate hike cycle won't happen until September 2024. And so the question is, will that, just after the election. And the question is really, will that cause a massive recession? And I would argue that it probably will, just because of the
we have a lot of people. I don't know if you've heard our monthly macro markets episodes here, but we have a couple of people that we've been talking to regularly. One, a former Federal Reserve economist, Claudia Sahm, and they are very much in the soft landing camp in that group. Do you think that's absurd?
I don't think it's absurd. I think it depends on what they do. Again, I think if they are able to slowly lower rates into this situation and increase liquidity, I think we could have I wouldn't say a soft landing. I would say a softer landing.
Okay.
But I think I think the fundamental problem is the debt issue and the inflation issue. And these are whatever they do to make the other one better makes the other one worse. So it's they have to choose their battle. Do they want the US to run into a severe fiscal crisis? Okay, then great, raise rates and kill inflation. You want to revamp inflation, restart QE and bring rates to the zero bound and see what that does. And fiscal deficits right now are 40% higher than they were last year, and we're not in a recession, right? This is another thing I ask people, like, why are fiscal deficits exploding if we're not in a recession? And part of the reason is structural. It's partly because baby boomers retiring, unfunded liabilities increase, like all the liabilities of the system are starting to come due. All these, the Medicare, Medicaid, VA benefits, Social Security, exactly. All these things are coming due. But it's also partially, tax receipts are down in a year that we don't have a recession. They're down by 7% per data from Luke Groman. And so if the Fed wants to thread this needle, it's very, very difficult. I think it's near impossible to get out of here without at least a mild recession. And any mild recession will make the fiscal situation worse again. So it's like, what do they do? There's no real answer.
5 years ago, and you told them that we were going to have. Well, no, let's go back a little further. If you talk to people from the year 2000, let's say before the dot-com crisis, and you said we are going to have periods of zero interest rate policy in the U.S., including one for many years, and at the end of it, people will be talking about coming out of it without a recession, they would have looked at you like you were completely and totally insane. Right? I honestly, I think the fact that we're even having this debate and conversation is really impressive. It has me holding the Fed in a higher esteem than I used to. And I know that is not a popular view, but I think it's amazing that we're even having the debate. I think anyone would have said 99-1 that we will have a massive recession coming out of a zero interest rate environment.
Well,
You think 50-50?
No, I think it's more like 70-30 towards recession. But I don't. Again, the severity of the recession depends on what the Fed does. It depends on oil markets, especially. But what I would say is
markets are signaling something of a recession. It seems now.
Exactly, and Bitcoin as well. I mean, the recent retracement seems pretty severe and fast. But what I would say as well is I don't know if you're familiar with Jeff Snyder's work and Eurodollar University, but it's really interesting. And one of the things he lays out is, the Fed, the economy kind of in many ways never really recovered post 2008. Worker productivity hasn't really grown meaningfully since then. You look at something like workforce participation, which is, I think, a better measure of actual employment metrics than the unemployment rate. And workforce participation is only back to the levels it was in 2018. It's not like we've been growing. And the amount of permanently disabled people from COVID, but also from other things, the amount of people on disability, on
boomers are leaving the workforce too.
Yeah, exactly. We're running into this problem that's going to hit us no matter. It's a wave that's going to hit us no matter what. And so even if it wasn't, again, ignore the problem, ignore the idea of the U.S. could lose reserve currency status. The fiscal situation is untenable. And the debt and the unfunded liabilities, which is
let's just put the blame squarely where it belongs. This is all the fault of the boomers, right? We can agree on that, right?
Are you a boomer or no? You're Gen X. You're Gen X.
Ouch.
Damn,
you have the gray hair. I'm sorry.
I know. It's too much gray hair. I am not a member of any generation. Okay, I occupy this weird 4-year window between millennials and Gen X that is not any generation. We're called the cuspers, okay? And so I am neither a millennial nor a Gen Xer. I am most certainly not a boomer, but I appreciate that with this amount of gray hair, you.
I apologize. The beard and the gray hair, listen, it's a combination. I thought maybe he's a very young.
In Dave's defense, and more on his side, I'm looking at you thinking, is he old enough to drink? So I mean,
I have the opposite problem
really quick.
I have the opposite problem.
Grow a beard, man. It makes you look older.
I should. I hate the way a beard makes me feel though. No, I'm in my late 20s, but I have a baby face, so I look like I'm 18. I get carded
when I was 20. Well, I like on and off, but like from 25 on, I had it because I wanted to look older. And now, whatever, I've given up. I didn't have it, for the record, I didn't have any gray hair before COVID. So this is like when you have young kids and COVID, this is what happens.
The stress of COVID is what started it. Okay.
Oh, God, yeah. And now I look like a boomer, but that's okay. All right, let's talk about something more fun for a minute. DRS. Yeah. Let's talk DRS.
We've been waiting on this conversation for a while. Listen,
I know we have.
Don't get me started. You're going to have to pull me back in, but I'm really excited to get to talk about this with you, PB, because it's something that's been in the works for years now. And I mean, we're at, like 28 months just since the computer share DD series started, and since we really started seeing numbers going up and they're being tracked. And then Dave had a tweet. He said that, what did you say about the recent DRS numbers, Dave?
I said I found them literally unbelievable. Now, it doesn't mean impossible. I just don't believe them. Something really seems off there to me.
Yeah.
I mean, I don't know. Like, I don't know. I'm not saying it because I know the intricacies of this system or I have a concrete idea, but the odds that a full quarter goes by and there has been no change over 100,000 shares, no net change to impact the number seems so improbable to me that I really struggle to believe it versus is it reflecting something else and we just weren't aware of that or something?
Yeah. And so I had a Twitter Spaces on the GME earnings day, and there's a Twitter account in there, Conway Yen, who is kind of poo-pooing on DRS and saying it's all, this is showing that no one really buys it. No one really is interested anymore. The FOMO is over. The movement's over. Just throw in your towel and go home.
Mm-hmm. I think that
I was about to say, I blocked them. I've been about a year of bliss without them in my ear telling me I'm a shill for looking at DRS. Yeah, yeah.
Well, Conway does have some good options analysis, but I wish and we did push back, me and some other people pushed back a little bit, but it was at the very end of the Spaces and I had to run, so I just had to kind of cut it off. I wish I'd pushed back more, but it is a weird situation, right? Like, what is happening with the DRS numbers? Why did they peak a few quarters ago and just going down? And I'm actually working with there's a finance professor. And he wants to he gave a presentation on DRS and the DRS phenomenon just a few weeks ago, and he wants to write a research paper in a major academic journal, and he wants my help. And so me and my intern have been collecting data for him. We got the Bloomberg data, and there's just weird things going on. Like, Mainstar is a small broker that had about 1.2 million shares in DRS, and they put out a notice a few months ago telling their clients, hey, we're withdrawing everything from computer share. They're going back to the DTCC. And the month and the drop in DRS numbers from the quarter before to the quarter after Mainstar reported was exactly 1.2 million.
Right.
It's as if somebody said, okay, there's been no buying, there's been no selling. The exact amount that's been pulled out because of Mainstar is the exact amount that will drop by.
Yeah.
Something very strange.
Something seems very off. It seems like this number is not the actual share count direct from the transfer agent. It seems like the number is being derived in some other way. Mm-hmm. And that's like the only and again, that's not based on anything. I don't have any like unique insight into this. It just seems the probability of this is so low. Like if it was dropping, it would make more sense to me, right?
Yeah.
But to just hold still, that doesn't add up at all.
Yeah. And you know what else is another clue that we've been looking at is before, I think it was before December 2022, the volume, the high volume days were just isolated to giant spikes in GME price. But after December 2022, so about a year ago, there were giant volume spikes only on DRS record dates. So you see, like, here's a DRS record date in like May of 2023, and the volume spikes from 3 million shares, which is the average, to 60 million. And then the next day it falls back to 3. And then 3 months later, it does the same thing on a DRS record date or a quarterly reporting date. It just shoots up and then it just falls back. And this hadn't happened before December 2022. So the question is, what's going on that's causing this level of volume? And on those dates, by the way, I went back and looked. Some of the dates didn't really see huge price action. Like it might go up 3%, 4%, but it didn't result in a massive spike. And so something else is going on behind the scenes. And this is a puzzle that's, I think, it's deeper than anything else I've ever looked at, because I've never learned so much about swaps and options and married puts and FTDs as I have investigating this whole phenomenon. But
crazy.
It's strange. It's like, I don't know what's going on. I don't know who's trapped, and I don't know how they're getting out of this process. I don't know how they're able to fudge the numbers, if they are fudging them.
Right. That's what I can't figure out. Because this is reported by the company. Yeah, there was language that changed at one point.
Yeah.
Which made it seem like maybe the numbers coming from the DTCC rather than the transfer agent. But I don't know. Like, I can't tell. And if that was the case, I'd be far more suspicious, because if it was coming from the transfer agent, I would say, well, then I don't see any way to manipulate that. That seems like you have to believe it, and that's what it is. But if it's not, then I could possibly envision all sorts of ways to manipulate that number.
And that's the whole system is so opaque. I mean, there's a tweet I found when I was looking for something else earlier from September of 2021 where we're trying to decode. We're like, wait, where do these purchases even come from? Like, we're trying to decode the system, and that's what led to a ComputerShare AMA, ComputerShare has been awesome in helping educate the public as much as they can, but even they don't have the answers, and it's been really, you just keep hitting brick walls of like, where's the man behind the curtain? Like, even in a system where you're supposedly supposed to have full ownership, I still don't know what's going on with my shares. I don't know where they come from. I don't know how they're still being manipulated. The whole book versus plan debate, which I think most people are at least on board with the idea and starting to find confirmation that book is the only true DRS. That's my opinion. That's not financial advice or anything, but that's just what the community has been coming up with for the last couple of years. But we can't even confirm these things. It's like, how are these things held? Are they held in the DTCC? So it definitely does seem like that's not coming straight from the source, like you were saying, Dave. In which case, once one hand gets in the pie, then anybody's hands can get in the pie, and you don't know who all got some pie and who, you don't know where the mess started. So it becomes a game of telephone. And I feel like that's a lot of what happens with GME numbers in general is just, they're fake. They're all fake. So.
And here's the other weird thing, right? So about a month ago, I got access to a Bloomberg terminal. And we looked at the ownership summary, right? And the ownership summary says 28%. And everyone was telling me that DRS was roughly 25%. And on the ownership summary, it marks it as other. And I had my intern reach out to Bloomberg through the chat function and say, okay, we know what institution means. We know what individual. We can understand what these designations mean for holders. What is other? And why is it so high? And they told us we cannot define that. And so they have a function on their ownership summary of individual, institutional, other, and others number 2 right behind institutional. And it's 28% of the float, and they can't tell us what it is. They're like, we don't know how. We
didn't write the requirements to define that within our own system or anything.
And it's their own system, and I was like, what? what is going on? Are you serious? And they wouldn't talk to us about it. And when you look at the other reporting requirements, obviously for most companies, it's like 2%. It's at the bottom of the list, 1%, 2%, which is what I assume the transfer agent is, right? That's the only thing I can assume. I mean, there's also other discrepancies. They double count Ryan. Any shares that Ryan Cohen holds through RC Ventures are double counted as institutional and insider shares. And when we saw that, we're like, hey guys, like you should probably choose because it's making the numbers look off. And they just said like, oh well, it's both of those things. We'll put them as both. And it's like, that's not how you guys should work. You should choose it. I would just call it an insider, right? Who cares that he has an institution holding it for him?
I mean, we struggled with the same thing on Irvin. It's a pretty tough thing. We decided to just show all the data, and people can kind of at the moment compile it for themselves. We're working on like the right way to compile it all down. But if you go to Irvin and you go like to the security page, you can see ownership. And you've got institutional and insider, and then we just pull out all of the transactions, and for some of them we're able to say like what that means relative to the float, because sometimes that information is reported by the company, but when it's not, you're just it's kind of a guessing game, which is kind of crazy, right? Like it's kind of crazy that this isn't very easy to define and simple, and you can just add these things up and here's your float, right? Like it's nuts how complicated it is.
Yeah, it's overly complicated, and opacity and overcomplication is how they hide any shenanigans, right? This is what they do. Right. And complexity so it on purpose. Yeah, it makes it so you have to have super high IQ and spend hours and hours and days learning about it and talk to insiders and figure out all these secrets. And even then you don't know fully what's going on.
So how does GME fit into your views on markets and economics?
Well, GME broke, my traditional efficient. I already had doubts about the efficient market hypothesis, but after GME,
this is what did it.
Threw it out the window. Well, it just further confirmed my suspicions that a lot of what I was being taught in and what I was taught in traditional finance and economic courses were just not right. The efficient market hypothesis has 7 preconditions, and all of the 7 preconditions are wrong. They say infinite liquidity at the risk-free rate. They say instant and perfect information symmetry between market participants. Not true. Like non-emotional trading. Not true. There's every single thing of the efficient market hypothesis is wrong, and this is what I was talking about with the
strong form. I mean, the weak form.
Yeah, the strong form.
I'm not gonna defend
even the weak, but GME shows holes even in the weak form, right? If several hedge funds are able to put out articles and FUD a company and short it down to a central level, that shows that if it's only a few participants doing it, not a majority market participants trading it, deciding that the stock price should be lower, then that tells you that this isn't, markets are more driven rather than emergent, which is bad because we thought that markets were an emergent, price was an emergent phenomenon of markets. Exactly. And if price is a driven phenomenon of markets, that means people can change it, right? And this is, there was that.
I don't think EMH envisions like the impact that you have on supply and demand from short selling. As just like a very simple mechanical matter, okay, like a de minimis amount of short selling, it's not going to make a difference. It's going to be immaterial. But if you have the float short, that means you've doubled the supply of shares in the market, right? And how is supply and demand supposed to reflect a price?
That's exactly right.
And you talk about needing liquidity to prop up the markets. It sounds like they've just like the whole market is just weekend at Bernie's. Like that's what I'm hearing.
Nice meme. I like that one.
That's a good one. And well, so here's the funny thing is, a few weeks ago I put out a tweet on Twitter and I said, short selling should be illegal, like just straight out. And I got tons of hate all across FinTwit. You're an idiot. Markets will collapse. Dumpster fire. Like everything's going to fall apart. It's Mad Max. Like all price discovery is going to go out the window. And literally like 3 days later, South Korea banned short selling for 2 years. And the South Korean, stock market corrects 5%. And then within 2 weeks, it's back up to where it was before. And so everyone who had told me, like, one of my friends markets with May, she's very brilliant, ex-Goldman managing director, like knows a lot. But she was saying the same thing of, if you could take away short selling, all liquidity is going to evaporate, and then all stock prices are going to plummet, and it's going to be Armageddon. And same with Wendy Peppercorn and some other macro fintech people.
I mean, it's
the
same thing that they say about naked shorting. Oh, sorry. I mean, the shorting that market makers who are bona fide do,
naked shorts,
under the Madoff exemption. It's not naked, but they say the same thing. They're like, oh, you take that away. If market makers can't short without a locate, the system will implode. It's horseshit.
Exactly, and that's what I was trying to show them. Like, look, I try not to be too combative on Twitter, although I know that my views can be very combative as they are, but that was one hornet's nest I didn't realize I kicked when I said that short selling would be illegal. All these people just pile on me. You're an idiot. You don't know what you're talking about. You don't have a background in market liquidity. And I'm like, well, look at this. South Korea bans it, and their stock market's doing fine.
Yeah.
And
I'm not personally ready to go there, but I do think that there are serious problems with enforcement and regulation in the U.S. and Canada and other countries, developed markets, where these things need to be revisited and fixed. But I find I have to fall back on those traditional arguments that if you ban short selling, you will reduce efficiency and increase transaction costs. But I don't think the bottom would fall out of the market or anything. I think that's kind of a silly view. Like we saw during the great financial crisis with banned short selling in financial stocks, and yet they kept falling because we were in the midst of like the great financial crisis. But, I don't think it was related to shorting.
Yeah, exactly. There'll be price discovery no matter what. And I agree, if short selling was well regulated and well enforced, and people were, not just slapped on the wrist, but banned from trading when they were caught breaking the rules, they were said, okay, here's a 30-day suspension, and then you do it again, it's a 90-day, and you do it again, and you're banned forever.
Right.
You're just not owning any equities ever again. You're going to sell everything you have, close up your shop, and you go home. You can go, go make a farm, or go try to short sell your house. Do some other sort of short selling.
Yeah.
Not here.
Has to mean something. That's what it's. We've got to give regulators some teeth. Like an FTD has to, if you keep telling your kid that they're going to go to timeout, but you never send them, then it's just ineffective. And that's basically what we have happening.
Exactly.
It's crazy.
Yeah. So that needs to change. And currently it's hard because we're all, all the financial regulators are SROs. So they're self-regulatory. So they're funded by the very firms that are regulating. And that also needs to change if we want to change the system. If we need to say, okay, like, they get funding from Congress no matter what. They don't care. They should not care about the profitability of the firms that they're regulating. They should say, hey, these are the rules. We don't care if you make a ton of money. We don't care if you make little money. You follow the rules. And if you're breaking the rules to make more money, then you're out, goodbye. You're done.
Yeah.
Quick shout out to We the Investors on leading that charge in that conversation. Because it definitely needs to be had.
We push hard on that, and we've talked about it a bunch in the past about the fundamental problems with the SRO model, and the lack of enforcement, and the idea that people, it's just fines. But then look, when FINRA tries to kick a firm out like Alpine, and now they're facing a constitutional crisis that might wipe them out of existence because of the crazy court system in the U.S. at this stage. So I don't know. Yeah, for this stuff, I don't know if there's a good answer other than, we need a regulator, and we need one with the right authority and the right resources and the right people, and that'll increase the fiscal deficit too.
Wait, so FINRA is facing a constitutional crisis, or do you mean Alpine is?
No, FINRA is facing an existential crisis. Alpine has challenged their ability to bar them from the industry. FINRA's ability. They've said that's extrajudicial.
Wow.
It's crazy. It's totally crazy. And I'm not, we're not here to defend FINRA, but they finally tried to kick out a firm who was also engaged in abusive short selling amongst other things. And now it's like going to the Supreme Court. Crazy town.
Wow. That's insane.
Anyway, PB, this has been great. Really enjoyed the conversation. I feel like there was a lot more we could have talked about. So much like Dollar Endgame, we might need a part 2, part 3. But you're doing some great work. We really appreciate it. I find it fascinating. Love reading what you're putting out there, and really appreciate you coming on and taking the time with us.
Of course. Thank you so much. And, thanks for spearheading the We the Investors. I signed up using an add-on email account, so I'm part of your mailing list, so I get it.
Right on.
Awesome.
Yeah, I'm a huge fan and supporter of that movement. And I really, I want to use my voice in any way I can to further, market fairness and transparency, because it's not only the global monetary system that's broken, like we've learned, it's also the U.S. stock market and market making and liquidity and everything. It seems like everything is a little bit off. So if we can bring it back to more normalcy and more fairness, I'm down for that.
I think a lot of that people care now, and that's why I feel optimistic that we're going to get this. We're going to figure all this out.
For sure. And a lot of that starts with a vote. So be sure to register to vote. Everybody listening, if you're not, you should be.
So thanks everyone for listening. Another episode of Let's Talk Markets. Hope you enjoyed this especially long one, but I really did. And so I'm going to assume you did too. As always, please subscribe, leave us a rating, and check out Irvin Finance, irvin.finance. You can sign up for our beta. We're going to open it up soon. We've got some great data on there, good conversations happening in the community. And if you didn't see our last episode, we did a sort of year in review, and we talked a lot about that. So thanks again, everyone, for joining us and listening, and we'll see you next time.
Thank you.